Hey there and good evening. Welcome to this episode of Kazi na Mali. Now, last time we took time to look at just an overview of entrepreneurship, but today we'd like to take it even deeper and look at all matters credit access or access to finance. And now we know that there are institutions out there ready to give money or lend money to borrowers, but you always hear people say that it is not always a walk in the park. So what do you need to do right to just get that very important loan that you require? Now in studio we are joined by one and only Mr. Isaiah Munguti, the head of credit at SMEP Microfinance Bank. Welcome to our studio, sirs.
Thank you.
Great to have you.
Thank you, Vincent. Thank you
now,
for having me.
I know that there's a lot that we can talk about today, but before we get deeper, I want us to just make an understanding, because, you know, I know that when people come to you seeking credit, first of all, you have to look at the credit worthiness of this person.
Yes.
Make us understand a little bit what credit worthiness is.
Thank you, Vincent, and for this wonderful program that you're running. Yeah. It is always a pleasure for us who are lenders, to have an engagement where we can lay all our cards on the table.
Sure.
For the sake of our customers who are out there.
Yeah.
We treat them, every one of them, we treat them as potential borrowers. And so we find that this information is very key for them in that understanding. When we are talking about credit worthiness, that's just a large or a big jargon of saying we just want to assess what we would call four things from a borrower or from a person who walks into our spaces seeking for a credit facility. One, we'd like to know that the money we'll give you is adequate to meet the need that you have, and it's not excess, neither is it too little. Then after we give you the money, we also would like to know, do you have the capacity to pay that money? So we call that ability to pay. We look at that in various angles. After we establish that you can be able to pay the money through various other checks which we make very clear to the borrower. The third thing we ask ourselves is sustainability of the repayment. You see, we are giving you money into a future that is not known. So it is for us to satisfy ourselves to some level of assurance that if you're asking to pay this money in 1 year, in 2 years, you will actually be able to go the long haul. Then thirdly, after you're doing that, there come a very basic, a very important aspect of the consideration, which we call willingness to pay. A borrower can come and ask for money and have all they need to actually be able to pay the loan, but then they do not have internally the willingness to pay that money. That is very key for us. And then finally, because the future doesn't belong to us. After we have done everything that we could do,
the future is not for us.
Because the future is not for us, then we ask for what we call fallback. Should anything happen and the source of repayment is not feasible, we always go for a second option, and that is what we call a collateral. So just for those four elements.
Those are big words, but we need to break them down for our viewer to understand. But you talked about something about the willingness to pay and all that and all that. Talk about the credit history. How important is it? Because I hear you people talk about a negative, a positive, a bad, a good credit history. I mean, how important is it for you when one walks through the door to take a loan?
Good. A very good question. Thank you, Vincent, for that. Credit history is important because many people who are coming to borrow loans it's not the first time they're actually getting a facility. It may not be a very huge one. Even with the proliferation of mobile loans, there are those who have borrowed small loans here, credit here. You've borrowed from a friend and you've paid. But what is critical for a lender is if we can be able to comb through your history in terms of documents that you provide for us, to find information that can guide us in making a lending decision, to show us how you have behaved in the past when you have been advanced monies. Now, that was very difficult for us in the past. But in the current dispensation, in the current times, that has been made easier by the establishment of what we call credit reference bureaus.
CRBs.
I want to tell our viewers and anyone who would want to borrow a loan that CRB, as we call it, is actually a good thing in that it captures information about customers on how they have borrowed monies in the past. And the more that experience is of borrowing and paying, that is the history we are talking about. It makes us realize this is a person who is tried and tested. We'll give money and we know they will pay. I would actually, as a lender, be hesitant to give money to someone who has very good cash flows and what have you, but they have never borrowed a single loan in the past, and there is no record for that, because this would be their first time. The first time, so you'll be very hesitant. Yes. But now you've talked about CRB or the credit reference bureaus. You know, this for me, even me, before I got to understand it, I thought it's a very bad thing because of how it is created and ironed out there. I mean, is it a good thing, a CRB, or is it a bad thing? Because people think that wakikutaja, actually what they say is, you've been umewekwa CRB. And when you're told that, and blacklisted.
And blacklisted.
They use a very heavy term,
yes, blacklisted. Can you
let me break it down for you, Vincent. Yes. CRB, the purpose of CRB is number one, like I've said, it captures information about borrowers and their past. CRB has at the core of it has a very good intention for all entrepreneurs. It will have benefits to the entrepreneur, it will have benefits to the lender, and even to the economy at large. Now, how is it beneficial to the entrepreneur? It is this way. Any borrowing that you make, that institution is required through that regulation of credit information sharing to forward that data to CRB. Now, CRB does not, and that information being shared is not necessarily negative information. In fact, when we started out with the CRB, I think where it got the wrong perception was when we were only sharing negative information. But now we are sharing both the good and the ugly. So what is happening is you share the good information, and that information is shared among all the lenders. Anybody who have subscribed to the CRB and is a lender will be able to go in there and download a report for Vincent and check Vincent, has he ever borrowed? If he has borrowed, how has he paid in the past? Is there also, times he has struggled and what have you? So that information is what is listed there. But it's good to understand what is the purpose of CRB. The purpose of CRB is a bigger actually, in the big picture, is to get to a point where we have eliminated people, the bad elements in the lending, in the borrowing, who come in, borrow and disappear with lenders' money, and we remain with those who are actually properly intentioned borrowers who pay loans. And at the end of the day, because most of them are struggling with collateralization, we get to the point where someone who has a very good history of repayment will be receiving, I think they will be receiving letters in their mailboxes of banks wanting to give them money, or lenders wanting to give them money without them asking
because of a good credit
of a good credit history. And that's where we want to get to. They will be able to get very good scores which allow them to get money without providing a collateral.
Does this really, the credit history, the negative, the positive credit score in the market, does it determine the policies that you and the institution that lend out money come up with?
Definitely, to a very large extent, that is true. Because, like I've said, the sector under MSME, if you look across many lenders, it has been noted that there is a very high level of default. That is usually brought about by also the high failure rate of some of these businesses. Those who study that market well have said that most businesses will not most startups will not live to celebrate their second birthdays. and another portion of those that survive will not live to celebrate their fifth birthday. And so if they have been advanced funds at that particular level, you can be sure that there will be default. So the aspect of default informs what policies we lay in place, we put in place towards lending in that sector. Secondly, to the institution again, it's about profitability. We are there to make money. We are there to see a return on investment. So if that money also finds that money lend and the portfolio that is under the MSME is not very lucrative in terms of even returns, then the funds may be diverted to better segments which have better returns. And so that will also impact on that. Yes.
Now, for the very first time, for this one very first time that is coming to ask for credit, so to speak, or to borrow money from the institutions, then what are the preparations that this person should have ensured before he walks through the door to come to your office to ask for credit?
That's a very, very good question, Vincent. I will want first, before I answer that question, to bust some myth that I've seen and I've experienced. When I meet a few people and they learn that I actually am a banker, and they have a borrowing need, or they're considering starting a business, one may approach me and say, I have this idea. Do you guys fund businesses? Do you guys give money for, or can you give me a loan for this?
To actualize the idea.
To actualize the idea. What I want to say is banks don't lend to ideas. They lend to businesses.
To businesses, not ideas.
Not ideas. We don't fund ideas, we fund businesses. Unfortunately, and it also goes in to fit to the stereotype that has been said that banks give money to those who demonstrate they don't need money. But we are getting out of it. Having said that, how would one prepare to approach a bank for funding? My take is this. I would give it a parallel and compare it with a patient who is going to see a doctor. As a patient, when you approach a doctor, you need to be able to, at least in a mild way, be able to explain to the doctor your condition. But then it will be up to the doctor, using their medical background and understanding, conduct tests through questions here and there, if they, and even go ahead and conduct interview and then even tests, and eventually prescribe to you the right solution. In the banking world, that is the same thing. In the lending world, that's the same thing. That borrower needs to come in with at least a mild understanding of what need they want the bank to fund. And of course, having socialized it, having understood what a lender would be comfortable with and not comfortable with. And after that, then approaching the lender will be able to think and advise the borrower on what would be a suitable facility for them. Many times we don't give borrowers what they ask because we know if we give you this, it will finish your business. You
give them what they need.
Yes. So we try to modify it to meet their particular need. And so what I would say is an entrepreneur would want to make a borrowing for the very first time. They need to approach a bank and create what we call a banking relationship. And it starts by simple, just opening a bank account. And right there, you would be able to indicate that I would want to make a borrowing in future. Nowadays, we are very keen on relationship management, at least from the institution where I come from. When one says that, then we will be able to work with them, visit the business, advise them what exactly they would want to, what we think would be proper borrowing for them, and work with them in the journey. Yes. So it would be more of a collaborative approach between the first-time borrower and the bank in determining what is the suitable solution for their business.
Yeah.
Yeah,
You've talked
lending.
That's a good one. You've talked about them creating that rapport with the bank, having a relationship, so to speak. And again, you mentioned about they should at least have this idea out there actualized in a way before they come to you asking for that loan. I mean, how important is market research, understanding, having this business knowledge? As you said, I mean, siwezi kuja kwa ofisi and I'm asking you to fund an idea that I don't even have any information about it. If I want to begin a business of milk vending, I need to have that information about it, done some research, done some risk management strategies and all that. Is this a bit of the thing that you also consider?
Yes. That's very good, because what we are saying is for one who intends to seek for funding and start or carry on a business, what one would expect is that you've done your own research. And not only have you done research, you have actually begun the business.
Yeah.
Because like we said, you will not be coming in with an idea only. You're coming and saying, I've started, I did my research, went into this business. This is my 6th, 7th month. I've now been able to appreciate how the market is. And now I'm coming for borrowing. Yeah. So what I would advise is borrowers needs to, or business people need to properly understand their business. It is very important for one to understand what business they are in. And it will come in many ways, that understanding. Like you're saying, market research will be, what sector am I in? Who will be my customer? What will be my products? And how diversified are my products? Who will be buying my products? Is it one customer? Will it be only one person, or it will be diversified? Because the more you have who are buying from you, the better your market is. Or are you also buying all your stocks or your raw materials that you'll be processing? Are they all coming from just one? Because that one, we call it concentration risk from the point of supplier risk. And then there is the buyer risk, where if you are also offloading to one. A good example would be, I'm running, I want to open a business to make uniforms. And I'm buying my material from several places, but the person buying from me is a government institution. Now there is concentration there, because then if the government doesn't buy, you remain with your stock. So that diversification is important. So one has to understand that. One has to understand then what are the risks that are inherent in my kind of business. What things would happen in the outside world which I have no control over in terms of economy, which can impact this. And then how do I project the future to look like for my business? So those are business plans and marketing plans, which also majority of our people who are starting out businesses, they may not have that luxury. But they are actually starting businesses anyway. So those are the walkthroughs that a bank, through a relationship, would be able to assist a would-be customer or would-be borrower to iron out, so that they form a proper understanding of their business, which now aligns well with banking in terms of its products, which they can enjoy or take advantage of.
Sure. Yes. I want us to talk about the mobile app lenders and the banks, you know. This has been happening the last 3-4 years, and it also came when that interest capping rule came in, but it was repealed the other day. We understand that. Do you think now that the institution like you, SMEP, have a competition? Because now they say it's easier for mobile app lenders to, I mean, for a borrower to go for a mobile app lender than come to us institutions. Of course, I know that the banks are also coming up with mobile lending and all that.
That's a good observation. Technology is here with us, and like it's being said, is the new norm. Technology has come to define and redefine the market,
and actually
and even lending.
It is the future.
And it is the future. And so we have to agree to it and then also align to that. For sure, when mobile lenders came up, they came into a market that had been also not very flexible, and came in with solutions that are instant. And a lot of startups, people in business, in financial need, went there and borrowed money. But of course, some went with an ill intent, borrowing, not wanting to pay. But clearly, they actually brought in, they actually found a niche in the market of quick loans. And that aspect of flexibility, speed of delivery is what is actually now becoming the new norm in banking. So they have actually brought out the aspect of that we need to consider the speed at which we give money to our borrowers. And so our policies have changed to that aspect. Are they our competitors? Yes, they are, because they are targeting the same customer. However, the only disadvantage that is there is that some of those facilities are very highly priced. They have very high rates compared to what they would find in the bank. So banks like where I am in SMEP, we have now a lending app, we call it Cash, purely for our own customers. If you are our own customer, we are able to give you a limit and you're able to borrow. This one is actually a limit. We don't give you a one-off loan. We give you a limit where you borrow, you pay, you borrow again, you pay at your, it's self-service. So we have managed to get that level to allow flexibility, the speed at which they are able to get money, and therefore they do not need now to go to the competition where they are charged heavily and penalized heavily, because as we are able to understand our own customers.
Yes, talk a little bit of what you do at SMEP, a little bit of what you do as far as credit access is concerned in a minute. Thank
you. Like I've said, SMEP, our focus is on the lower end of the market. Those businesses that are just starting out, the businessmen who we know, like it has been said, in the MSME sector, the biggest impediment for them to borrow has been the aspect of collateral. In SMEP, we have tried to circumvent that by bringing in new ideas of how we can support our borrowers in that aspect. One, we have what we call group lending. Group lending is a very wonderful idea of actually putting business people who are within a certain geographical region, not necessarily doing the same kind of business, but they are starting out and they know one another. We bring in the aspect of accountability and peer pressure. And so they come together. We give them formal training. We train them on running businesses, on personal finances, and the need to formalize their businesses. And then during this time, in incubation period, they are able to learn how to save, because once we give a loan, one will have to pay an installment. And if you've never paid an installment, it can be very destabilizing for the business or a very foreign idea. So through the mandatory saving that we put under the group arrangement, one is able to come and borrow a loan supported by the members. There will be no need for tangible collateral, which is required by commercial banks, and we'll be able to lend to that person. Two, but depending on those who come to us without going through the group aspect, we are able to consider them as on an individual basis. And what we do is we do what we call graduated lending. We start you from a small facility, 50,000, 100,000. We begin with you there, depending on your borrowing need, particularly those who have a challenge of collateral. And then we work with them. And some we have worked with them to the point where they have now proper collaterals. They are borrowing very good sums of money. So that is a second aspect that we use. And then thirdly, of course, those who can meet all the conditions, we also are able to onboard them. So that's how we have made our access to funding.
Now, with the credit information sharing, of course, we know out there nowadays, do you think there is enough credit information for borrowers out there?
There is a lot of work in progress in that aspect. We understand that Credit Information Sharing Society, CIS Kenya, is charged with that mandate. What that institution does, it works with the majority of lenders or service providers who give services, public services, and a proper and robust credit information sharing system is one where information about borrowers is brought from very many angles. Yeah. We are looking at a point when the maturity stage will be that information from supermarket is shared with CRB. Information from water bodies, those who supply water in counties are also sharing information. SACCOs are sharing information. Kenya Power is able to share information. When we have all these aspects, like it is in the developed world, we will be able to look at a customer and download information from a CRB, which is very all-round, that is able to give us information at just a click of a button about a borrower, and therefore be able to advance facility, knowing that the risk has been actually been reduced because the information is available. Information is actually what determines the level of borrowing one can actually get. Yeah.
I just want to give you a minute to break or bust that one myth about lending or credit access that you think that a borrower out there should understand.
There are very many. We bump into, into many as we go along. Yeah. But one of them is that not every borrowing, not every loan must be a term loan. Not every kind of funding, actually, let me call it, funding for a business must be a term loan where you pay on a monthly basis. There are many needs. If I had time, I would actually have shared about what are the borrowing causes and how would you schedule or craft your request to the bank.
We'll do that in our next episode.
Yes, so that you are able to be funded. But a good example is you may be running a business that is seasonal in nature. If that business has peaks in particular times of the year, maybe a monthly loan may not be the deal for you. We look at schools at times. A school has 3 terms, receives fees in January, collects again in either May, and collects again in September. Now, if the school comes and borrows a loan where they have to pay every month, where will they get money to pay in November when the schools are closed? So what would be the proper product for them would be a facility that would be actually payable once they collect their school fees. So that kind of alignment is very important and can only be understood when that need is shared and the bank is able to prescribe the right solution.
Fair enough.
Yes.
I mean, next time we'll talk about that and again get deeper into loan management. Now, after getting this credit, how do you manage it to make sure that it delivers what you took it for? Because some people sway it to do other things and gambling and all that. But we'll talk about that next
real
time.
Issues there.
Sure. Now, I want to thank you, Mr. Isaiah, for the time that you've had with us in breaking down the preparation for a borrower to walk through the door of a lender and ask for that very important loan. We'll have more time to talk about that. But again, that is all we had for you tonight in this episode of Kazi na Mali. Next week, as we have just said, we look into loan management. So I know that you don't want to miss this next week on Tuesday. But I want to leave you with a quote from Winston Churchill, who said that success is not final, failure is not fatal, it is the courage to continue that counts. My name is Vincent Kerosi. This is Kazi na Mali. See you next week. Enjoy your evening.